The first sign that a market has snapped is not a crash. It's confusion. It's when people start arguing over the number, because the number no longer behaves like a normal number. Did it really hit $92? Which contract? What premium? What conversion? And underneath all that noise is the real signal. The silver market has started acting like it has multiple prices at the same time. And when that happens, you're not watching a normal rally. You're watching a fracture in liquidity and a fracture in trust. That's what this headline, $92 silver appears in Asia, really means. Whether the print was exactly $92 or the Hiates dollars plus a brutal premium, the condition is the same. Something snapped. And the market is now revealing its stress in the place where physical demand is the most aggressive and where tightness shows itself early. Stay with me until the end. Because the biggest mistake Americans make is watching the US spot chart and assuming that's the market. In real commodity stress events, the chart is the last thing to tell the truth. The first thing to tell the truth is behavior, premiums, delivery terms, inventory reluctance, and the sudden urgency of buyers who can't afford delays. If this is a real snap, the next phase won't look like a clean uptrend. It will look like discontinuity, jumps, gaps, sudden repricing, and the kind of volatility that makes people feel like the market is moving without warning. The warning, in reality, was in the plumbing. Let's define what something snapped means in a serious way. It doesn't mean there is no silver on Earth. It doesn't mean every vault is empty. It means the system that normally keeps one global price has begun to fail at the margins. In a healthy global market, arbitrage keeps prices aligned. If silver trades higher in one venue, traders buy it elsewhere, move supply, and close the spread. That's how one price is enforced. But arbitrage only works if the system can move metal smoothly. It needs deliverable inventory. It needs reliable logistics. It needs financing. It needs time. And most of all, it needs the confidence that by the time you move the metal, the market conditions won't make the trade a loss. When any of those pieces weaken, price gaps can persist, and in tight markets, those gaps don't just persist, they grow. That's when you get extreme prints in certain regions. That's when you get headlines like $92 in Asia. And Asia is the perfect place for this to show up, because Asia is where a large portion of global manufacturing lives. It's where industrial buyers don't want exposure. They want metal. They want throughput. They need reliable supply to keep production moving. So when silver is tight, Asia is often where physical premiums show themselves first. Not because Asia is emotional, but because Asia is where procurement becomes urgent. Now, here's the critical distinction that makes the whole story click. There is paper silver, and there is physical silver. Paper silver trades in contracts, futures, ETFs, and synthetic exposure. It can be huge because it's easy to trade. Physical silver is the metal that has to be refined, fabricated, shipped, insured, and delivered. That physical market is smaller, slower, and constrained. When everything is calm, paper and physical stay linked. When stress builds, they separate. And when they separate enough, the market snaps into multiple prices. This is why the exact $92 tick is less important than the existence of the gap that allowed such a tick to appear. A snap is when the market stops behaving like one pool and begins behaving like several pools that can't connect quickly. So what caused the snap? Three forces colliding: structural demand, slow supply response, and a market structure that can hide tightness until it suddenly can start with demand. Silver demand today is not the same as silver demand 20 years ago. This is not just jewelry, coins, and a niche investor base. Silver is now a critical industrial conductor embedded in the technologies being scaled aggressively. Solar panels, EVs, modern vehicles packed with electronics, data centers, advanced computing, medical equipment, and defense systems. And much of that silver is consumed and dispersed into tiny components. It doesn't come back easily. Recycling exists, but most dispersed silver is not recovered at scale. That makes demand feel like a slow drain. Year after year, the metal is pulled into the real economy and doesn't return to the open market in a smooth, predictable way. Silver supply does not behave like people think. New mines take years to develop, or grades decline, costs rise, permitting and regulation slow expansion. And a major portion of silver production is byproduct output from mining other metals like copper, lead, and zinc. That means silver output depends on broader mining economics, not silver alone. Even if silver prices rise, supply doesn't surge next quarter. The market leans on inventories, the buffer, and buffers can quietly shrink. This is the part where people get fooled. As long as inventories exist, the market looks stable. But inventory is a cushion, not a solution. Once the cushion gets thin, the market becomes sensitive to small shocks. And in a sensitive market, a relatively small wave of demand can create extreme local premiums. That's how you get a snap print. Now add the third force, macro and financial behavior. The world is still living with the consequences of the inflation era and the debt era colliding. Even when inflation cools, the memory of it remains. Even when markets rally, the fragility underneath remains. Investors look for insurance assets. Gold gets the headlines. Silver gets the volatility. Because silver is smaller, more explosive, and more sensitive to shifts in sentiment. When capital rotates into metals, silver can move faster than people expect. And in a tight physical market, those flows can accelerate premiums and gaps. So what does the snap look like on the ground? Let's make it tangible. A healthy market gives you one price and smooth delivery. A stressed market gives you a headline price and a real price. The headline price is what you see on the screen. The real price is what you pay when you need physical metal, now especially in size, especially in industrial form, especially with fast delivery. When the market snaps, that real price starts rising faster than the headline price. Premiums widen. Delivery terms tighten. Sellers become reluctant. Buyers become urgent. And then something subtle happens. The conversation shifts from what is the price to can you get it? That shift is the definition of a market moving from price-focused to access-focused. And access-focused markets are the ones that reprice violently because price must rise enough to reduce demand and restore balance. Now, why should us viewers care about a snap in Asia? Because commodity stress is contagious. It spreads through supply chains, through corporate costs, and through investor psychology. If Asia is paying extreme premiums for silver, it suggests physical demand is colliding with limited deliverable supply. That tightness can spread to other regions if buyers begin competing for the same pool of metal. It can pressure U.S. industrial buyers who rely on stable silver inputs, electronics, energy infrastructure, medical devices, defense contractors, manufacturers. When procurement becomes expensive or uncertain, companies either pay up, lock in contracts early, or reduce output. None of those outcomes are neutral for the economy. And because silver is embedded in the hardware of modern life, rising silver procurement costs can become part of inflation persistence in ways most people don't directly connect. You don't buy silver at the store, but you buy products that contain it. When input costs rise across an entire supply chain, price pressure shows up downstream, but the bigger impact is psychological. A snapping silver market tells you something about liquidity conditions. It suggests the market's plumbing is tightening. When hard assets start behaving like they're short of deliverable supply, it often reflects broader stress in financing, inventory management, and risk tolerance. That can foreshadow volatility in other markets' rates credit, equities, because it reflects a world where the margin for stability is shrinking now. Here's the key question. What comes next? There are three likely paths after a snap signal like this. Path 1. The global price rises to meet the physical reality. The market reprices upward. The gap closes because the headline price catches up to the real price. Path 2. Demand weakens sharply and premiums collapse. This can happen during economic slowdowns or policy tightening. But if industrial demand is structural and inventories are thin, the collapse may be temporary. Path 3. Fragmentation and volatility become the new normal. The market stays jumpy. You see repeated episodes of premiums and gaps, especially during moments of macro stress. This happens when the system is structurally tight but still tries to trade. Enormous paper volume on top of constrained physical reality. If you want to know which path is unfolding, you watch behavior. If global price pulls back but premiums stay elevated, that's a sign physical tightness is real. If global price rises and premiums stay elevated, that's a sign tightness is intensifying. If both cool together, pressure is easing. The point is that physical behavior often leads the chart. Now, let's address the skeptical viewer who says, Isn't this just currency, conversion, and taxes? Sometimes, yes, local factors can amplify the price in a specific venue. But that doesn't eliminate the signal. The signal is that the market is allowing a major premium to appear in a region with heavy industrial demand. In a truly loose and abundant market, those extremes don't persist. When they appear and stick, it means the system is less flexible than it looks. And here's the final piece, the part that makes this worth watching to the end. Silver is a small market. It does not take much to create an outsized move. When a snap occurs in the physical market, and when attention turns to it, you can get a reflexive cycle. Premiums rise. Buyers rush, sellers hold, spreads widen, volatility increases, and then the paper price jumps to catch up. The people who get caught off guard are the ones who assumed the global spot price was the only truth. The truth in commodity stress events is often in the gap. So whether the print was exactly $92 or the Hyades dollars plus a brutal premium, the real message is the same. The market is showing you it's under stress in the place where physical demand is strongest. That is what something snapped means. It means the system is losing its ability to keep one price, one pool, one reality, and once a market crosses that line, the next phase is rarely slow enough for everyone to react comfortably.